In this Python notebook, I'm going to spend some time exploring Rob's Advanced Futures Trading Strategy number 27. Unlike some of my previous videos, I haven't invested tons of hours into preparing this, so it's very rough around the edges. If I've made mistakes or misinterpreted any of Rob's work, please shout in the comments. This strategy, number 27 from Rob's book, is mainly a mean reversion strategy. It trades quite frequently compared with most of Rob's other strategies, i.e. potentially multiple changes in position each week. This strategy also incorporates some aspects of trend following, and as a result, its performance is safer and arguably better than a pure mean reversion strategy. I must declare up front that there is one element of strategy 27 that I have deliberately excluded from this notebook. In Rob's strategy 27, the position size we take is partly informed by whether the recent levels of price volatility are higher or lower than the long run levels of price volatility for the instrument we are trading. So if volatility is currently very high relative to historical norms, a more comprehensive implementation of strategy 27 would require that we reduce the size of our position. I did implement this feature in this notebook originally, but subsequently I decided to remove it. I'm not sure why. I guess I felt the strategy was becoming a bit too complicated for my tastes. I know Rob could provide evidence to show that adding this relative volatility multiplier enhances the strategy's performance, but I also take to heart Rob's warnings about overcomplicating your strategies. I begin by importing some familiar libraries and tweaking the display settings of pandas. In this notebook, I'll be assuming I'm trading just one instrument, the CME Micro E-mini S&P 500. I haven't devised a way to automatically update the current price, so I'm setting the current price manually in the following cell. Price now equals 4354.5. You can get that from the CME website. Next, I'm reading in some end-of-day prices. I downloaded these from NinjaTrader, which I have access to through a temporary trial account. I have not been careful about how I have stitched together the price series for the different delivery dates for this E-mini micro instrument. If I was to trade with real money, I would of course go back over this step and ensure I have stitched the price series together in a fashion Rob would approve of, probably the Panama methodology. One other thing to note, the end of day prices I have are actually what the CME refers to as the settlement prices. I cannot recall offhand what precisely Rob regards as being the appropriate closing price to use, but after a brief conversation with ChatGPT about this matter, I decided the CME settlement prices are a reasonable choice for the purposes of operating this strategy. So I have a CSV file with my price data called strat27data. I read it into a pandas data frame. I then tidy up the formatting of the date index and I get rid of weekends. And this is a snapshot of the resulting data frame: date, open, high, low, settle price, and the volume of contracts traded that day. So I've read in my end of day prices. In the lines below, I'm adding some important columns. Firstly, the percentage daily change or daily return, which is just the percentage change in the settlement price. Secondly, I'm adding the exponentially weighted moving average of the closing prices. The first has a span of 16, this is the fast moving average. The second has a span of 64, that's the slow moving average. I'm adding a trend filter column. Firstly, I calculate the difference in the fast and the slow moving average. And then if the fast moving average is higher than the slow, then the resulting figure will obviously be greater than 0. And if the inverse is true, then it'll be less than 0. If it is greater than 0, then I want this column, trend filter, just simply to have a value of 1. If it's a negative difference, then make the value of trend filter -1. In other words, if we're in an uptrend, the value is 1. If we are in a downtrend, the value is -1. Rob uses the exponential weighted moving average with a span of 5 days to determine what the current equilibrium price is for this strategy. So I add equilibrium price, and that is the exponentially weighted moving average of the settlement price with a span of 5. This is the price that Rob hypothesizes the current price should tend to gravitate towards. So this is the mean price. Hence, we are talking here about a mean reversion strategy. I then go on to add the volatility of this instrument using the exponentially weighted moving average. The exponentially weighted moving standard deviation with a span of 32. This is what is written in Rob's book. This is how you determine this. This is the appropriate way to determine the current daily volatility of price. I then add another column which is again expressing the daily volatility, but not in percentage terms, in actual price, in terms of the price points. Finally, I add the volatility of this instrument in percentage terms, but on a per annum basis. And you get that by taking the daily volatility and multiplying it by 16. So let's check the data frame I now have. I have the prices and volume as I had before. Now you can see I've got the daily return in percentage terms. So this day exhibited a decline of 0.66% versus the previous settlement price. The exponentially weighted moving average price using a span of 16 is this. The slower moving average is this. I can see that the fast moving average is lower, the number is smaller than the slower moving average. So I know we're in a downtrend, and that's confirmed by the trend filter column, which is showing -1. The equilibrium price is, or the mean price is 4374 at the moment. We have the daily volatility in percentage terms, so 0.78%. In price terms, that's just over 34 points on the S&P contract. And the annual volatility in percentage terms is 12.5%. So I'm confident I've not made any mistakes, because I just happen to know that US equities have an annual volatility that is something like this. Sounds about right to me, 12% or so. Moving on, I'm defining some Python objects here. First of all, my capital. Let's just say it's $10,000. My risk target is 20%. My annual risk target is 20%. So in a typical year, I'm happy enough if my capital is fluctuating by 20%. I don't want my capital to swing up or down by $4,000, which would be 40%. That's too much of a roller coaster. 20% is about right. The contract value multiplier. Each tick of the E-mini micro is worth $1.25. There are 4 ticks in a point. So to go from 4377 to 4378, there are 4 ticks. So each point is worth $5. Hence the contract value multiplier is equal to 5. The current contract value is just this multiplier multiplied by whatever the current price is. The typical annual volatility of the contract is the value of the contract multiplied by the annual volatility in percentage terms. The target annual volatility of our capital is, well, it's the $10,000 multiplied by the 20%. That's easy. Now the ratio of the target versus the contract value volatility, in other words, this one divided by this one, well, that's telling us if we desire our capital to have an annual volatility of $2,000 and the actual contract we are trading itself has an annual volatility of only $1,000, then we have a ratio of 2. And our standard position is this value again. Why did I even bother with this value, this line of code here? I'm just, for my own benefit, I'm restating what this ratio is actually hinting at. It's hinting at what our standard position should be. If the target annual volatility of our capital is $2,000 and the contract itself has an annual volatility of $1,000, then this number becomes 2, doesn't it? So that our standard position for this contract, we need 2 contracts in order to achieve our desired capital volatility. We have a block of code here which is just restating the values we've just calculated. I think it'll be helpful to run through this. The current contract value is nearly $22,000. In other words, if you bought one of these contracts, just one, and then it drops in price all the way to 0, then you've lost $22,000. The typical annual volatility in the value of this contract is nearly $3,000. The target annual volatility in our capital value is $2,000. The number of contracts required to match our desired volatility is 0.73, because the actual one contract is generating more volatility in dollar terms than our desired volatility in dollar terms of our capital. So our standard position is 0.73 contracts. Hence, in practice, our typical position would be 1 contract, since we can't trade less than 1. Now with that out of the way, let's try and calculate the current forecast of this strategy. So the equilibrium price, or the mean price, I calculated that earlier, didn't I? But by tagging on this -1 at the end, I'm just taking the current equilibrium price, not yesterday's equilibrium price or the equilibrium price as it stood a week ago, what it currently is. Then calculate the raw forecast, which is the equilibrium price minus what the price is right now. That gives us a raw forecast. So if the equilibrium price is higher than the price now, our hypothesis is that the market should tend to gravitate back towards this equilibrium price. So we should be, right now, we probably have a desire to be long because the current price is below the equilibrium price. Calculate the risk-adjusted forecast. That's the raw forecast, which we just calculated, divided by the daily standard deviation of price expressed in terms of price. Raw forecast divided by the current daily volatility. That gives you the risk-adjusted forecast. Let's dwell on this line for a bit. If the raw forecast is 35, i.e., the difference in the equilibrium price from the current price is 35 points, it prompts the question, is that a big difference or a small difference? To answer that question, I need to know by how much price typically fluctuates on a daily basis. If the typical daily fluctuation is 350 points, then a raw forecast of 35 is trivially small and will result in a risk-adjusted forecast of 0.1. Whereas if the typical daily fluctuation is 35, then our risk-adjusted forecast will be 1, and so on. We then move on to calculate the scaled forecast, which is the risk-adjusted forecast we just calculated, multiplied by what I have called the Carver scalar. And the Carver scalar is 9.3. It is more correctly known as the forecast scalar. It is a number that Rob has calculated using lots of historical price data. When this number is multiplied by the risk-adjusted forecast, it results in what Rob calls the scaled forecast. The scalar of 9.3 is not a random number. It is 9.3 because that is the number that ensures the scaled forecast will, on average, across lots of historical data, have an absolute value of 10. I think the purpose of the Carver scalar, or forecast scalar if you prefer, is to make the forecast values more intuitive for us. It means we can interpret a value of 10, a scaled forecast of 10, as being a typical forecast. So a value of 5 would be half the typical forecast, a value of 20 would be double. If we did not multiply our risk-adjusted forecast by the scalar, then this forecast, in our current example, would be 0.582, and I would struggle to tell you if that is a big or small forecast value. Moving on, we generate the capped forecast, which is simply the scaled forecast, but clipped, so it cannot be lower than -20, it cannot be greater than 20. Remember, a forecast is trying to quantify how confident we are about being long or short. A positive forecast means we should be long, a negative forecast means we should be short. A positive forecast of +10 means we have a standard level of bullishness. A positive forecast of +100 would mean we are extremely bullish, and we would feel compelled to have a very big long position. Rob cautions against taking very large positions relative to your capital, and hence we cap our forecast to a maximum of +20 or -20. So our forecast will only ever compel us to have a position that is twice as big as our standard position. And we did define what a standard position for us is earlier. The standard position is 0.73 contracts, or in practical terms, 1 contract. Now I'm defining what I have called the conviction strength. Maybe I should have called it the conviction ratio. It's the capped forecast divided by 10. I'm calling this the conviction strength. I'm dividing by 10 to get a ratio that goes from -2 all the way up to +2. So +2 means you need to be long twice as many contracts as what your standard position is. Not 20 times as many contracts, but twice as many contracts. And our target position is our standard position multiplied by our conviction strength. That's the 0.7 multiplied by the conviction strength of, well, it could be as high as 2. So let's print what these various values were. I think that will be instructive. The current equilibrium price is 4374. The current price is 4354, which is lower than the equilibrium price. There's a difference of 20 points. The daily volatility in price terms of this contract is 34 points. The risk-adjusted forecast is this raw forecast divided by the daily volatility, which is 0.58. We multiply that by Rob's scalar of 9.3 to give us the scaled forecast of 5.4, which we cap at no greater than +20, no smaller than -20. So there's no change there because it was already only 5.4. The conviction strength is just this number divided by 10, 0.54. So we want approximately half our standard position, which is 0.39. So actually I would round that and say we want 0. We don't actually want a position at the moment. The current price is too close to the equilibrium price for us to bother putting a position on. At this point, we need to talk about Rob's advanced futures trading strategy book for a moment. On page 426, he gives an example where he calculates a target position of -11.68 contracts. He writes, since we cannot trade fractional contracts, we round this to acquire a short position of 12 contracts. I'm not 100% comfortable with this. I would rather we have a short position of 11 contracts. I will explain why I think that in the next few cells. Just keep this in the back of your mind. So let's get on with calculating limit prices. Rob's book explains that it is possible to calculate the specific price at which we ought to be long or short some number of contracts. He gives the formula to do this, and I have done my best to implement it in this cell. My code here leaves a lot to be desired, but hopefully it serves its purpose. Let me talk through this line of code as an example. Price long 3 is defining the price at which we think we should be long 3 contracts. And it runs as follows. You take the equilibrium price and then you subtract from that all of this. So you've got some numerator divided by some divisor. This formula is not intuitive. Let me try to untangle it. We have the equilibrium price, and from that we're subtracting this stuff on the right. Let's focus on the bottom part first. Our standard position, you will remember, is 0.73 contracts. And that reflects the amount of capital we have, the typical volatility of the contracts we are trading, and the desired level of volatility we want to achieve for our capital. And we multiply that by the Carver scalar, which is 9.3. So the divisor becomes 6.8 in this example. Now turning to the numerator, we have long 3. I've defined that as simply, that means you want to be long 3 contracts. So this is just the number 3. We have the number 10. Recall that a forecast of 10 represents our standard level of conviction, our typical confidence level. And then we have the current daily volatility of the contract we are trading. So we multiply these 3 elements together, and it comes out as 1031, because 3 times 10 times 34.4 is 1031. Now, if you take the 1031 divided by 6.8, you get 151. So let's subtract 151 from the equilibrium price, which is what the formula is telling us to do. It gives us a price of 4222. And that's considerably lower than what the current price is, and indeed what the equilibrium price is. It's saying if the price is 4222, you should be long 3 contracts today. How do I feel about the explanation I've given above? Well, I said the formula is not intuitive, and I don't think my explanation has made this formula any more intuitive. The formula that Rob sets out on page 427 of his book is worked out by rearranging some other formula that he already presents in his book. So although the formula you start with in his book are perfectly intuitive, if you start rearranging it, as Rob had to do, even if the rearranged formula is still mathematically perfectly correct, perhaps it is unavoidable that the rearranged formula is now more difficult to interpret intuitively. As you can see above, I'm struggling to interpret how this formula actually makes sense and gives us the prices at which we should be long or short 3 contracts or 2 contracts or what have you. But we trust Rob not to lead us astray. In this block of cells, I'm just repeating the same code, but now I'm saying, well, what's the price at which we should be long 2 contracts or 1 contract? What's the price at which we should be short 3 contracts or short 2 or short 1 contract? Now we get to the final block of code. I'm going to plot a diagram to see what we've done. The code is not important here. This is just my plotting code. Now we'll spend some time here. Let's talk through this plot. Firstly, the red horizontal line at 4352-ish is showing the current price. The yellow line is showing the equilibrium price, and obviously that does vary over time. The basic hypothesis underpinning this strategy is that the red line, the current price, should tend to gravitate towards the equilibrium price, the yellow price. So I can immediately see at the current time, we should be somewhat bullish about what price will do next, because the current price is below the equilibrium price. And that resonates with what I calculated earlier. I calculated a capped forecast of 5.4 and a target position of 0.39. These are positive numbers. It's telling us, let's be bullish. We want to be long. The dashed red lines are showing the prices at which our strategy wants to take action. The red lines are shaded red because it is signifying we want to be short at these price levels. So this price level is saying, if price gets here, you want to be short 1 contract. If price gets up here, you want to be short 2 contracts. If price gets up here, your position should be short 3 contracts. Hang on, I said, on the one hand, we are currently somewhat bullish, and yet my plot here is only showing the levels we should be short at. Yes. Remember, early on we created a trend filter column. And it turns out we are currently in a downtrend. The trend filter is currently -1. And that follows because the fast moving average of price is lower than the slow moving average of price. And we are not, according to Rob's strategy, we are not allowed to go long if there is a downtrend. That is why the plot here is only showing us the levels that we can take action. We can go short because we are in a downtrend. But for us to go short, price would need to spike all the way up here. So the action we could take today is to insert limit offers at the 3 prices I've shown. One contract's short here, another short here, another to go short up there. So if the price today spiked up and triggered all 3, that's good. We will be short 3 contracts. And if today the price then starts to drift down, it will come here. And now our line is saying you want to be short 2 contracts. So actually we need to have bought a contract to get rid of one of them. So now we're short 2, and we creep down here. If price creeps down here, we need to get rid of another contract. We buy another. Now we're only short 1. And then when price gets back to the equilibrium level, the yellow line, we need to be flat. We need to buy another contract to get back to 0. I will end this video with a controversial point, because I will attempt to disagree with something Rob wrote, which is a very risky thing to do. Remember earlier I said I wasn't comfortable with the example in Rob's book that showed a target position of minus 11.6, and therefore Rob concluded we should be short 12 contracts at that time. I don't like that, because just look at this plot. Imagine instead Rob's example had a target position of minus 0.68. Does it follow we should immediately get short 1 contract? Well, in one sense, I don't feel happy about doing that, because then I followed Rob's book and I went on to calculate the levels at which the strategy should be short 1 contract or 2 or 3. And if the current price is implying a target position of minus 0.68, that means price has not yet got as high as this first level. It's only when price gets up to this level would I feel comfortable going short 1 contract. So on page 426 of Rob's book, I think the recommendation in his example should be to acquire a short position of 11 contracts, not 12, because then that is very consistent with his methodology for calculating the price level at which we should be short 12 contracts. And that price would actually be a little bit higher than where the price currently was in Rob's strategy. I feel that going straight to short of 12 contracts was jumping the gun. So I'll finish there.